Look at this receipt. 1971, a family of 4 does their weekly grocery run. Milk, bread, eggs, some ground beef. Their total? About $12. Now look at this one. 2025. Same items. Same store layout. Same hunger. The total? $68. The government will tell you that's normal. They'll call it inflation, a natural, unavoidable feature of a healthy economy. But here's the question. Nobody on the news is asking, why did it happen? Not when, not how much, but why, at the root level, does every dollar you earn buy less and less every single year? The answer starts on a Sunday night, August 15, 1971, and it involves a president, a broken promise, and a decision that quietly transferred wealth from your wallet to the banking system. Forever. This is the story they never taught you in school. To understand what happened in 1971, you need to understand what money actually is. For most of human history, money had one critical property. It was hard to create more of it. Gold and silver couldn't be printed. You had to dig them out of the earth. That scarcity gave them value. If you held a gold coin in 1650, it bought roughly the same basket of goods in 1850. 200 years, near zero inflation, then came paper money. And here's where it gets interesting. Paper money was originally just a receipt for gold. You'd deposit your gold at a bank. The bank gave you a note, a piece of paper that said, "This is worth X ounces of gold." You could trade the paper. It was convenient, but crucially, it was redeemable. You could walk back into that bank and get your gold. This kept governments honest. And you can't print more paper than you have gold. If you try, people notice. They show up demanding their gold, and you can't deliver. That constraint, that discipline, is what kept prices stable for centuries. Now, what happens when you remove that constraint entirely? 1944. World War II is nearing its end. The Allied nations, 44 countries, gather at a hotel in Bretton Woods, New Hampshire, to redesign the global financial system. The deal they struck was elegant in its simplicity. Every currency in the world would be pegged to the U.S. dollar, and the U.S. dollar would be backed by gold, redeemable at a fixed rate of $35 per ounce. America had the gold. After the war, the U.S. held roughly 70% of the world's monetary gold reserves. So this made sense. The dollar was as good as gold, literally. This system created the greatest economic expansion in human history. The 1950s and 60s, post-war prosperity, a booming middle class, affordable housing, stable prices. Your grandparents weren't just lucky. The system was designed to protect their purchasing power. But America was spending. The Vietnam War, the Great Society programs, military bases across the globe. And to pay for it all, the Federal Reserve started printing more dollars than it had gold to back. By the late 1960s, foreign governments, especially France, started noticing. They looked at America's spending and said, "We want our gold now." The system was about to break. Sunday night, August 15, 1971. Richard Nixon interrupts a popular TV show, Bonanza, to address the American people. He says the words calmly, reassuringly, as if describing a minor technical adjustment. Nixon says, I quote, "I have directed Secretary Connally to suspend temporarily the convertibility of the dollar, temporarily." That word did a lot of work that night. What Nixon announced, in plain terms, was this. The United States would no longer exchange dollars for gold. The promise that underpinned the entire global monetary system since 1944 was broken, unilaterally, on a Sunday night. Foreign countries holding billions in U.S. dollars suddenly had paper backed by nothing but trust. Gold knew immediately what had happened. Within 2 years, the gold price had tripled. Within a decade, it hit $800 an ounce. The market was saying, this dollar is worth a lot less than you think. Nixon's temporary suspension? it was never reversed. The gold window has been closed for over 50 years. And everything, every grocery receipt, every mortgage payment, every student loan, flows from that one decision. Here's the number they don't put on the news chyron. Since 1971, the U.S. dollar has lost approximately 85% of its purchasing power. Not 10%, not 30%, 85%. The dollar in your wallet today would have bought $6.60 worth of goods in 1971. Think about that. The money didn't disappear. It was diluted, like watering down a drink until it barely has any taste. How? By printing more of it. In 1971, the total U.S. money supply was roughly $600 billion. Today, over $21 trillion. That money didn't come from productivity. It didn't come from innovation or hard work. It was created, digits added to a ledger at the Federal Reserve. Every new dollar printed makes every existing dollar slightly less valuable. It's a tax, an invisible tax, one that doesn't require a vote in Congress. Economists have a polite name for this: seigniorage, the profit a government earns from issuing currency. You have a more accurate name for it. You feel it every time you check out at the supermarket. Now here's where it gets political. The government measures inflation using something called the Consumer Price Index, the CPI. And according to CPI, inflation from 2021 to 2024 peaked around 9%, then fell back to 3 to 4%. Mission accomplished, they say. Inflation is under control. But the CPI has been quietly revised, methodologically, since the 1980s and 1990s. Substitutions were added. Weightings were changed. The formula was redesigned to produce lower numbers. One change is called hedonic adjustment. If a car costs more but has better features, a backup camera, say, the government may record that as no price increase because you're getting more value. The price went up. Your bill went up, but CPI doesn't fully capture it. And the categories that eat your budget the most? They're either underweighted or measured differently. Housing. The CPI uses a fictional concept called owner's equivalent rent instead of actual home prices. Healthcare. Structurally underweighted. Education. Tuition is in the index, but financial aid assumptions affect the calculation. Independent economists who used the original 1980 CPI methodology before all the revisions calculate that real inflation ran between 8 and 12% at its 2022 peak. That's not conspiracy, that's methodology. Forget the headline number. Gee, look at the things that actually determine your quality of life. Housing. In 1971, the median U.S. home price was $25,000. Today, it's over $400,000. Wages in that same period grew roughly eightfold. Home prices grew 16-fold. The ratio broke. Education. In 1971, a year at a four-year public university cost around $400. Today, over $10,000. And private universities, north of $55,000 per year. Healthcare. Per capita healthcare spending in 1971, $352. Today, over $13,000. That's a 37-fold increase. Three of the most essential purchases in a human life: shelter, education, healthcare. All three have massively outpaced wage growth. All three accelerated after 1971. This isn't a coincidence. When money can be created freely, it flows first to assets, to things that are scarce. Real estate, education credentials, medical services. And it prices out the people who earn wages in the inflating currency. The rich hold assets. Assets inflate. The working class holds wages. Wages lag. That is the mechanism of wealth transfer hiding in plain sight. So what do you do with this knowledge? Understanding the disease is step one. The second step is positioning yourself on the right side of it. History gives us a clear answer on which assets preserve purchasing power when fiat currency is debased. Number 1. Gold. Gold isn't an investment, it's monetary insurance. From 1971 to today, gold has gone from $35 to over $2,300 per ounce. It didn't become more valuable, the dollar became less valuable. Gold simply measured the decay. A 5 to 10% allocation in gold has historically smoothed portfolio volatility and preserved real wealth across decades. What number 2? Real assets, real estate, and commodities. The home price data is brutal if you're a buyer, but it's protective if you're an owner. Real estate is a claim on a scarce physical thing. Farmland, energy infrastructure, commodity producers, all of these tend to maintain value as paper currency weakens. That's why institutional investors load up on them. Number 3. Equity in productive businesses. Great companies can raise prices. They pass inflation through to consumers. Pricing power is the ultimate hedge. Over 50 years, the S&P 500 has beaten inflation, not because stocks are magic, but because a share of stock is a fractional ownership in real things. Factories, brands, intellectual property, human talent. The assets that don't protect you? Cash savings sitting in a 0.5% savings account. Long-duration bonds when inflation surprises to the upside. Anything that promises a fixed return in nominal dollars. The system rewards those who understand it. It punishes those who trust it blindly. Your grandparents bought houses, raised families on single incomes, retired with pensions. You're not less capable than they were. You're not lazier. You're playing a fundamentally different game, one where the rules changed on a Sunday night in August 1971, and nobody sent you the memo. The inflation you feel every time you open your wallet is not a natural disaster. It's the predictable, documented result of a monetary system designed to transfer purchasing power from savers to debtors, from workers to asset holders, from you to institutions with first access to newly printed money. Understanding that is not optional anymore. It's financial survival. If this gave you a new lens on the economy, share it with someone who's wondering why they can't get ahead. And subscribe, because the next video in this series covers how the petrodollar system was built on Nixon's broken promise, and what happens when it ends. See you there.